How you doing, Apollo?
Good. How are you? Good to see you,
Yeah,
Greg.
let me kick us off. So, hello, and thank you all for joining us for another economic and market update. I'm Greg Friedman. I'm the founder and CEO of Private Ocean. Today, our guest speaker is Dr. Apollo Lupescu. I never did ask you how you pronounce that, so I hope I got
It
that
was
right.
pretty good.
Um, Apollo is a vice president at Dimensional Fund Advisors, and DFA is one of the premier investment managers, literally on the planet. Also, a really important partner of ours, so we're really honored and pleased to have him here today. I'm told he's considered the secretary of explaining stuff, and I would describe what that is, but I think he's just going to show you in terms of explaining really complex things in ways that we can all understand. Right? That's a real skill. That's great. Apollo's been with Dimensional for over 16 years. Prior to that, he taught at University of California. He also had his own consulting firm. He received his PhD in economics and finance from UC Santa Barbara, which is one of my alma maters. So awesome. He holds a BA in economics at Michigan State University. Um, what I really liked is you competed and coached water polo. So I could never do that because I couldn't swim that long. However, so today what we're going to be doing is I'm going to be asking him some of the questions that we're most getting from clients uh, at a high level. And then time permitting, if people want to chat and ask questions, if we have some time, we'll get to them. And if we don't, no problem. We'll actually follow up. We'll follow up in writing. Yeah, and with that, let's go ahead and get started. Thank you and welcome. I appreciate you
Hey, Greg.
being
Good to
here.
see you, and thanks so much for the invitation to be here, and thanks to everyone for joining and listening in.
Well, we're excited to hear what you have to say. So I'm going to start with probably the most frequent question that we've been getting ever since the market took a dip, came back up, and then just kind of is where it is. And it's this: there seems to be this disconnect between what's happening with the market and what we see every day on the news. We watch the economic numbers, the unemployment's off the charts, um, the biggest contraction, all these kinds of things. Millions unemployed, virus possibly in multiple waves. I mean, you get the idea. And what
Right.
people are really confused about is, well, is it possible the market is not understanding something, right?
What's it
What's
missing?
yeah, what's it missing?
Yeah. No, and it's actually a really interesting question because quite often when you do listen to news, the market and the economy they're kind of tied together, and it's like it doesn't make sense. The 30 million people unemployed, and you see the businesses are hurting. Everybody's not doing well. So how is it possible that after that pretty bad quarter one that we had in Q2, the market has rallied and it's actually positive for the year? So a lot of people can't really wrap their hand around that, and also the Nasdaq, which you hear on the news, it's significantly up for the year. So how can it possibly be? What's wrong with this picture? And to begin with, I'll start with just a quick comment: is that the market and the economy they're related, but they're not the same. Maybe to think about it, the economy, the market tends to move a lot more than the economy, and maybe think of somebody walking a dog that sometimes they go faster, sometimes they go slower, but they're pretty steady pace. And that's the dog walker. But the dog, especially a Jack Russell, is kind of all over the place, moving everywhere. But eventually they get to the same place. It's just that the market tends to get there with a lot more movement. And that's kind of what's to some degree is the distinction between the market and the economy. They're related, but not the same. But to be specific to your question, Greg, why is there such a disconnect? When you look beneath the surface and you take a deeper look, it turns out that the disconnect between the market and the economy might not be as great as it seems when you watch the news. And why is that? Well, to begin with, if you think of the businesses that really took the biggest hit in this pandemic, this economic downturn, they are the small local businesses. They're the main street shops. They're not the very large companies, even though they got hit as well. But the brunt of this was borne by the local shops, by the local restaurants, by main street businesses. And those businesses are not represented in the stock market. They're just not. They're just not big enough to be in the stock market. And through just a twisted irony, the companies that are in the stock market somehow might stand to benefit. And why is that? Well, when knock on wood, but let's say my local coffee shop closes, Well, who might swoop in and get the location? A large national chain. When we cannot buy from the local shops because they're closed, what do? You go to these online retailers who get bigger and bigger. So in some respect, the biggest hit was borne by businesses that are not part of the stock market. But even the businesses in the stock market, when you actually take a deeper look, it's so interesting to see sort of what the data shows you. And I'm a big fan of data, so I'll share with you some of the data that we've seen in the market, and I trust that Greg, you can see the screen.
Yep.
Okay, so the data that's so fascinating to me is that if you look at the S&P through a few days ago, through the end of July, it's up about 2.3%. So let's just say around it at 2%. So how can possibly the market be up 2% when we go through all this? And here's the way that I wanted you to think about it, is that a lot of it has to do with how we measure the market, how we keep score. It's hugely important, because if you look at the S&P 500, which is what a lot of professionals use, and you kind of break it down and you say, okay, well, that S&P 500 has 500 companies, and then you look at the largest five companies in the S&P. They call them the FAMA stocks: Facebook, Amazon, Apple, Microsoft, and Alphabet, the parent of Google. What you find is that these five stocks have shut the lights out. They have performed tremendously well, 35% year to date, these five stocks. Again, it's maybe not surprising, because we have moved from buying from local retailers to these five shops, because they're the ones who somehow in this pandemic they offered something that was needed. But what's fascinating is that when you look at the S&P 500, these five companies amount to 22% of the value of the S&P 500 in terms of the U.S. stock market. So they carry a
Wow.
tremendous weight. These five companies are responsible for almost a quarter of the performance of the S&P, and they have done incredibly well. But the question is, what if you look at the other 495 different stocks in the S&P? What do you see then? And what you see is that when you look at the remaining stocks, they're actually down for the year. They're down about 7% for the year. So it's not that the stock market's doing tremendously well. 495 companies, they're down significantly for the year, but they're being pulled up by these five tremendous companies that have shut the lights out, and they carry a big weight in the market. So because of that, people might say, well, the market's up. In reality, the majority of the companies are not. It's just these five companies with large weight are pulling everybody up. And if you look below this, there are about 2,000 other companies which are not part of the S&P, but they're still part of the U.S. stock market. And when you look at those, they're down even more. They're down 11% through the end of July. So that's what I'm saying. The disconnect, it might not be as great as it seems. It might just be that when you realize that these five companies carry such tremendous weight, and they've been dominating this period, because they just somehow they're the ones that provided services and goods that people needed in this moment in time. They've done tremendously well, and they pulled up everybody. But by no means does it mean that the entire stock market is doing well. It's just a subset of stocks that are now really doing tremendously well.
So that's very similar to the late 90s, right? I'm
Very,
that
very
old.
similar. Very, very
I'm
similar.
I'm having deja vu all over again, because I
I mean,
remember
in
like in
more than one ways.
1998.
It's so fascinating because it's in more than one ways. If you think of the late '90s, it wasn't just about how big these companies grew, but what happened when they grew so big. You remember what happened in the late '90s? There was a big story around a technology back then.
Yep.
It was Microsoft.
Yep.
And it got so big that the government stepped in, and they basically said, wait, we need to take a second look at you. And what's fascinating is what happened just last week when you had the heads of the four families who had to go testify there. And it is not unlike what Bill Gates had to go through 20 years ago. And what's fascinating is I was looking through this, just trying to understand what was the impact of these hearings on Microsoft. This is Microsoft on January 1st of 2000. It was about $37 per share. I just looked it up on Amazon just a few minutes ago, not on, on Yahoo. And then if you look at the end of the decade, this is 10 years later, the price for the same share of Microsoft was now $24, which is the third loss in value over 10 years. And I can't attribute the whole thing to the hearings, but Bill Gates did admit that there was a distraction to have those hearings happening at the time. So
Wow.
it is interesting in some ways. There are some parallels to the 1990s.
Yeah. All right. Thank you. That was helpful. Okay, so there's a sense among many of our clients and a lot of investors that it's similar to what we're talking about, that the market's overly optimistic. There's a comeuppance coming, or traders missing something or whatever. If we see a drop in the market or high volatility returning, and you just explain that it's really probably going to be driven by those 4 or 5 companies, is that something's wrong with the market? Is that correcting itself? What's that telling us? Uh, if something starts happening to these companies, I mean, that's what you're saying is that's driving it, right?
So, so there are two questions there. One, what's going on with these companies and what can you expect from that? And secondly, what if volatility returns because we miss something and we don't know something?
Uh,
Well, let me answer the volatility first, and then I'll go to the companies. When you as an investor, or any of us as an investor, go to the stock market to buy shares of ownership in any of these companies, not just these five FAMOC stocks, but the 3,000 companies that you can buy in the US, you become part owner into that company. And we all want to get ownership, not only that it gives us a stake in capitalism, but also if you are a part owner into that business, you are entitled to part of the profits that the company gets to make. And that's why you want to buy that ownership. You pay for that ownership today, but years and years down the road, you're going to get paid as an investor. So the value of how much should I pay today to have that ownership in company? You basically are looking as a business owner. I want to buy a business. How much should I pay for it? That's how I like people to think about this. And what's fascinating is that as a business, if you try to buy that business, the first thing you need to know, well, what do I expect the company to make in profits? That's really relevant because that's what I'm buying, future profits. Well, it turns out that this is a really unusual period. And typically all these companies in the US market, they do give investors some guidance on what their earnings might be over the next quarter or the next year. And if the results are actually above or below the guidance, then the stock price adjusts for that new information. But there's a guidance right now because things are so topsy-turvy and nobody has a playbook on how to deal with this. About 40% of the companies in the S&P 500 stopped offering guidance on their earnings. So investors are a bit flying in the dark right now because if the company itself cannot give guidance, how would an investor know what the true value is? So I do expect that
hmm,
the volatility will continue just because, when I'm looking to buy ownership into a company, if I don't know what money I'll be getting out of it, well, that's going to create some fluctuations. And so I wouldn't be surprised, but that's not a sign that the market's not going well or that it's not working well. It's exactly the opposite. It's a sign that the market is working well. Because what you have for every time you transact and you want to buy shares of ownership, you don't go to the company to buy them. For every buyer, there has to be a seller. And these are private parties. So you have to compete with somebody else. And obviously, everybody's doing their homework, but these are buyers and sellers that operate in a free market. And at the time when the trade happens, they both have to be happy. So, in other words, what people pay incorporates not only the opinion of the pessimist who maybe we've missed something, but when a transaction happens, for every pessimist, there has to be an optimist. Because if you're buying expecting that it's going to go up, not expecting it's going to go down. So not having enough information is one side of it. But the competition that exists among investors is the driving force of why I think the market's doing. It's incorporating whatever we know. If things, so everything that we expect is already put in the price right now about the value of a company. If things look better than we expected, it's going to go up. If they look worse, it's going to go down. But there's a certain expectation that is baked into the price, and that's fundamental. Now, what about these large companies? Should we kind of maybe emphasize them more? Maybe they're the future, and now why not put more money into them? And we've looked at this exact question. Once a company becomes large and dominant, do they continue to stay dominant? And in that respect, you look at the top 10 stocks going back to the 1930s. And what we saw is that these large companies, once they get to be in the top 10 largest stocks, and this is over each decade going back to the 1930s, what's fascinating is they continue to stay up there. You take AT&T, it was the largest holding in the 1930s, and for 70 years, it was in the top four. So once it's there, it's likely to stay. You have General Electric that was basically there from 1930 all the way into the 2010s. So it's a very long term. So I don't know that what's going to happen to these companies, to the Apple, Microsoft, Google. What we can see though is that these companies do actually, once they get up there, they tend to stay large and dominant. So that might be the case with these pharma stocks. It's quite possible that that might be the case with these pharma stocks. But what's interesting to me and what's interesting to an investor is a bit of a different question. It's not whether or not these companies will continue to be great dominant companies, but also will they be good investments? And that's a very different story. That's a very, very different story, because not only that what you see is that you might invite more scrutiny from the government, but on the other hand, you become more mature. There's not as much risk, so the return to investors might not have to be as great. But also that eventually it's harder to grow. I mean, I don't know how easy it is for Facebook to double in value or Amazon to double in size. And what you see when you look at the data is that 3 years after a company joins this top 10 list, they do tend to outperform in the short run. Relative to the market. So, relative to the market, when you look at these top tech companies, they do outperform over the short run. But then, as you extend that to 5 years, what you see is they do run out of steam. And over 5 years, they actually underperform the market, and when you look at a full decade, they significantly underperform the market by 1.7%. So these companies, they might continue to stay big, but whether or not they are a good investment, that's a very different story. And at least what the data is suggesting is that it is good at that point to say, I'm happy that I've had this, but I'm also going to look for the next Amazon, for the next Apple, for the next Google, and that's sort of the suggestion that we would have.
Good. Okay. I want to switch gears a little bit. As you know, most of our clients know, um, we definitely, there's a lot of research and a lot of data on institutional and academic investing, essentially around factors.
Mhm.
And can you talk a little bit about, just describe factor investing and how and why the research shows that from other approaches, it historically has done better?
Okay. So, what is factor investing, and how to think about this? So, what factor investing basically means is that if this square is the stock market, is all the companies in the stock market fit in this box. The traditional, conventional way of thinking about investing, pioneered by Benjamin Graham and then picked up by Warren Buffett, is who was actually Benjamin Graham was his mentor, was this idea that if you analyze individual companies, you give yourself a competitive edge. And what you ought to do is, once you analyze companies, find the right companies. What's going to do really well? What's a high quality company that you can buy at a fair price? And cherry pick a handful of these and leave out everything else. That's the traditional stock picking approach to investing. And for a while, it's possible that you could have gotten a competitive edge because you had better information or because you can process it better. But it turns out that information flows so freely today, and it's so competitive to the point there are more professionally managed mutual funds in the US than actual stocks trading on the market. So it's crazy competitive that this particular system, it's a little bit like blockbuster video in the age of Netflix. The renting VHS tapes is not state of the art. So what emerged in starting in the 70s from the academic hallways community, and this is what dimensional and pretty much the academic community pioneered, was a different way to think about investing, where you're not doing analysis trying to understand and form an expectation about any one company, but rather put those companies and try to understand a basket of stocks to which they might belong. So, what factor investing is really about is doing research at a much larger scale that doesn't look at individual company, but rather the company as part of a larger basket, a larger group. And I was trying to explain this for years in a way that like even my mother-in-law, none that they'd even heard, but like my father-in-law and like people that are not experts can get it. And one analogy that's helped them is think about when you look at a school of fish, and I've seen some swimming, and you can look at every fish and it moves up and down, left, right, sideways. You can't really tell how each fish will move and what will do next, but you get a much better sense and you can capture and understand the behavior of the entire school of fish with a lot more precision. And that's fundamentally the difference. A factor investing is not trying to predict the behavior of any one fish, but rather look and understand the behavior of the entire school of fish. So that's the big difference. A stock picking is about using the rod and trying to fish, and that might be fun. But if you really want to make a living out of that, you do need to use a net and be more professional about it. And that's been the big evolution in investing, in my view, is evolution from stock picking to much more of a factor based, where you're trying to understand the characteristics of larger baskets of stocks. And in that respect, the fundamental premise is that not all stocks are the same. Of course, we intuitively we know they're not the same. So how do you group them? The media does them based on technology, pharmaceutical, transportation. We've looked at that, and it's not the most robust way of doing it, because I'm not even sure today is Facebook uh, uh, um, and Google are typically considered technology companies, but what they sell is advertising and competing with Viacom and ABC. So what academics found is that there is a different way to go beyond it. So sectors have a secondary relevance, but the primary relevance is not based on that, but rather something that has economic intuition and it's backed by data. And the first factor that came in terms of the factor investing in the late 70s, early 80s came from the University of Chicago. And it was the idea that when you look at two companies and you have the large companies that we see in the S&P 500, well, there's also a large swath of about 2,000 other companies which are not part of the S&P. We talked about it a second ago, and they're called small caps or small company stocks. And if you look at these two, intuitively, they have to have a different profile, a different risk return trade off, and different opportunity to grow. And let's just take two companies, McDonald's and Shake Shack. And if you look at these two companies, they're both burger joints. But which one of them is more robust in a way that they have a longer track record, they have deeper pockets, more resources, more processes? Obviously, McDonald's. But on the other hand, Shake Shack, I can see that company growing and doubling in size perhaps easier than McDonald's. So in that respect, there is a difference between large and small at the economic level, whether it's because of the risk return or because of growth potential. And that's exactly what you see in the data. We have this book called the Matrix book, and I know Greg has been very familiar with this for many, many years. It's a big book of data and invest. It's probably my favorite investment book. And you look at the growth of a dollar in my dad's lifetime. He's by the time he turned 92, he's 93, about to be 94. And it turns out that if he had invested $1 in his lifetime in the S&P 500, which are the large companies in the U.S. market, that dollar would have grown to about $7,000. Same exact dollar over the same time period in small would have grown to about $27,000. So significantly more growth in small rather than large. And that's one thing that I think investors can do. You can do better than what you see on the news with the S&P if you also pay attention to small companies. Now, in among all the large and among all the stocks in the 80s, there was a further delineation that had to do with the price at which you buy these companies. And the price, if you have a company that sells for a low price for its earnings or book value or dividends, those are called value companies that have a low price for an accounting fundamental. And historically, these low price companies have had greater returns than the more expensive counterparts called growth. So knowing that small beats large and value beats growth, the one part of the market that ought to give investors the biggest bang for the buck is the one that is small and value, And if you look at the same dollar growth over the exact same time frame, that would be roughly about $72,000. So this asset class, this factor investing, is basically saying, let's just not worry about individual companies, but put them in the context of much larger groups of stock, which is called an asset class, and then be very purposeful as an investor on how much do we emphasize different parts of the market. And the more you emphasize small, the more you emphasize value, that gives you a chance for a bigger bang for the buck over the long run. And that's what factor investing is. So you don't have to settle for market returns. You don't have to say, well, factor investing means that I'm just going to get the market returns. Not at all. It's your call. It's your that's exactly what you and Private Ocean and the advisors would decide. Well, how much do I want to, let's say this is an ice cube tray and that's the stock market. It's perfectly level. All the cubes at the right amount of water. To what degree do I want to tilt this, take some water from large and growth, and then put it down towards small in value so I can get a higher opportunity to grow? And not necessarily do this, not put all the money in small in value. Now, the last thing that I'll tell you about factor investing, Greg, is, which is the most important thing here, is that when you see these numbers and you say, well, that looks pretty good. Why not put all the money in small value? Or I don't have 92 years, or what's the catch? Or why doesn't everybody do this? The big thing about this is that this is a very scientific, data driven, almost like an evidence based approach to investing. And what it means is that this is not about certainty or guarantees. The same way that, if you go get a bike and you go on the trails in Marin, or if you eat healthier, or if you stop smoking, that's not going to guarantee you a longer lasting, healthier life. All it does is improve the odds. So this is a lot about understanding the odds, understanding the numbers. And what I mean by that, if you look on an annual basis, not even a quarterly basis, but on an annual basis, at let's say, how often do you see small outperforming large? What you see is that on an annual basis, about 60% of the time in any given year, you see exactly the result that you expect. Small will outperform large. But what it also means is that 40% of the time, or in 10 years, you're not going to see it. So it's not there every year, but even after 1 year, your odds are better with small than they are with large. And if you give it more time and you go to 5 years, well, if you go to 5 years, then the odds improve again, and you have 2/3 of the time that you see the results that you expect. But even now, 1/3 of the time, it's not going to be there even after 5 years. So, the biggest risk here is that people go through a period like this and they say, aha, I'm done with this. This didn't work. It's been 5 years. Well, again, if you saw these odds, it's possible that you can run into one of these periods. But if you saw these odds, which part of the market would you like to emphasize? You tell me.
Sure.
And because you do have periods like this, when even after 5 years you might not see the results the way that the long term expected to be. It is good to have some large. It is good to have some growth rather than put all the money in small and value. But that's in my view that the fundamental difference between the traditional approach and what is factor investing. It's a very powerful way, but it does have to be done carefully with an advisor who can optimize this pretty much around the world.
Okay. That's great. Um, I actually, there's another question I want to ask you, but before I do, we actually have some questions coming in that
Mhm.
I think I'd love to ask you,
Yeah,
if that's okay. Um,
absolutely.
one of the questions that I'm seeing, what factors could lead to a sizable inflation in 2021? And I would actually expand that. Because I had a question, and I don't know if these are the same questions, so I'm going to throw out another one and then
Mhm.
either handle them one or two or different. One of the things that I think about is what are the long-term implications of the massive amount of global debt and including U.S. That's occurring and going to occur to
Right,
get us through this.
right.
And I think it's related to inflation to me. And I
Yep,
also think it's more than just 2021. So I'd love to answer his question shorter
right.
term, and then also because I think about 5 and 10 years. Despite my youthful exuberance, I'm, you know, no buying green bananas, right?
Yeah.
But
Um, Yeah, no, that's I mean, so the question of inflation and particularly the stimulus money that we've seen, It's something that we can even go back to the 19, actually not the 1990s, but in the 2008, 2009 crisis when we had this idea of quantitative easing, which is a program that really pumped a lot of money in the economy. And a lot of folks wanted to know, will this lead to inflation? And what we saw is that it didn't actually lead to much inflation. And in my view, my view as an economist is that part of the reason that we didn't see inflation is because inflation quite often comes when the economy overheats. And what does it actually mean? Because you hear this on the news. Everybody might mean something different. To me, this is what it means: is that if you're producing something, let's say that you're making this pen, and that's your business, making pens, and now the government and the Fed dumps a lot of money in the economy, and there's more money, and more people come and want to buy your pens. Well, at that point, if you have enough capacity so you can absorb the additional orders without actually increasing prices, well, that doesn't lead to inflation. So even as you put more money in the economy, if the capacity is there to absorb, then it won't lead to inflation. So the inflation is really much more about the capacity of the economy than anything else, and what the economy can produce. And in the case that we've seen the last 10, 12 years, is the economy was able to absorb because it had capacity. And so the big question is when you have all this money that's being put in the economy, will there be enough capacity? And to me, when you asked about 2021, this is again my personal view. I don't have a crystal ball, even as I do have one. But I think that the big issue here has to do more with a trade. I do think that the inflation won't necessarily be because of all the money being put in there, but because the economy and these companies have built supply chains that rely on a global trade basis. And in my view, these are being disrupted. And look, I don't need to tell you, go try to buy a bike. You guys have marine bikes in your backyard. You go try to buy a bike from them. You try to go buy, I have a portable shower that I take to the beach sometimes. You try to buy anything these days, and it's a very long time before you get it. And part of it is the coronavirus, but part of it is the disruption to trade. And if you get these situations where we just don't have enough capacity, that's going to lead to price increases a lot more than the fact that we have money in the economy. So that's what I would watch for is the capacity. Now, what do investors believe, and what's their expectation for inflation? And it turns out, Greg, that there is a way that you and all of you can go right now and find out exactly not just what people think in hypothetically or when they talk on the news, but how do they vote with billions and billions and billions of dollars every day. And there is a vote that shows you what their expected inflation will be. And I'll share with you a screen, which is pretty much a website that is live. I'm just showing you a live website that you can Google. I can send you the link to this website. It's the Federal Reserve Bank. And it turns out that there are two types of bonds. One, bonds that take account of the inflation before they pay you, and the other one that doesn't take account, it pays you the same rate irrespective of inflation. So when you look at these two, you can actually get something that's called a 5-year break-even inflation rate. And it kind of says right here what it is. It's the measure of expected inflation that you can derive from the investor behavior and the way they put their money. So what you see is that for years, the inflation expectations have been very, very low. But once the crisis hit, in fact, what we saw was a huge dip. So to the point where the issue there wasn't inflation, but more deflation. And what we've seen over the past few months is there is a recovery more towards the long-term average. But if you want to know what is the investor's expectation of a 5-year inflation rate, it's about 1.5% today. So the markets are not looking at this, and all these billions of dollars that people put in there, what they're saying is that we think that the rates are going to stay low for the foreseeable future, and we'll actually spend billions of dollars and we invest it that way. Why is that? Because if they didn't believe this, and this is the key insight, if they didn't believe this, if they thought the inflation would be higher, they just wouldn't be able to accept such a low interest rate because if I don't even make inflation, why would I accept this rate? And a great example is the 1980s. The expectation of inflation was about 10, 15%. that's the base for the interest rates. Interest rates are like a 10-15% because you need to recover inflation. So it was a long-winded answer, but I don't think the spending the money itself is the issue. Is more the capacity of the economy. And right now, the way that investors are voting with their billions of dollars, they're saying that we expect inflation to stay low for the foreseeable future.
Wow. Okay. That's very helpful. Um, by the way, we should uh, we should email out that website. That's definitely good. Um, a question that came in: value investing. Didn't Fama and French say the value premium has mostly disappeared? I don't know if they had or not, but what's your?
Um, I'm not aware of them saying that the value premium has disappeared. What it is basically what people are looking for. So we kind of had that sketch that you, if you remember, that we're looking at small and we're looking at large and value. And what you see is that over the past 10 years, those relationships haven't really played out the way that people expected. So if you look at the performance of value stocks, we kind of talk about 5 years that it happens at a third of the time. You don't see that in the data. But over the past 10 years, what we saw is that when you look at the performance of value minus growth, what you see is that value has underperformed by about 4%. That's the performance of value minus the performance of growth for an entire decade. So people are looking and saying, wait, that's what's wrong with this picture. It seems like value is underperformed for a very long time. Does it still make sense to invest the same way? And we've looked at this, and there are a few things that kind of jumped at me. The first one was that we have about 9 decades of good data when it comes to the stock market in the U.S. And the question was, how often in these 9 decades do we see such a significant underperformance? How many of these 9 decades we see similar patterns? And what was interesting to me is that it's a bit unusual, but not unprecedented. 3 out of the 9 decades we saw this underperformance. So it wasn't just the last decade, but when you look in the 90s and you look in the 30s, once again value underperformed growth quite significantly over that period. So as an investor, you might tend to say, and I'm questioning this, is I'm skeptical because it's been 10 years, not one or two or three, 10 years of significant underperformance. And when we looked at this, the question is, does it make sense to change strategy? If you had changed strategy, how would you have fared on the subsequent decade? And what's fascinating is if you fast forward now another decade, on the following 10 years, what you see is that value came back with a vengeance and significantly outperformed growth over the next decade. So this underperformance, even for the long term, we have seen it before. And then, value does turn around and come back with a vengeance. But there's another big picture here that I think it's so important to look at. Whenever you see this number, you see value minus growth, the tendency would be to say, well, it's disappointing to see value doing so poorly. I actually have a different take. I'm really proud of value. I'm really, really proud and perfectly happy with the way value did. Why? Because if you look at the last 10 years, value did exactly its long term average. Value did pretty much the long term average. The anomaly here is growth. Growth is the one that is way above the historical norm. And it's not even the whole decade. In fact, if you look for the first 7 years, they're pretty much neck and neck, no big difference at all between value and growth. It's the last 3 years where value has continued to chug along, but the anomaly has been these large, expensive stocks that have shut the lights out. So my question has been like, what are you more afraid of? Something that is in line with the long-term average or something that is way above the historical norm?
Yeah.
And you kind of brought up the 90s. It's pretty much almost play by play what we saw back then with technology stocks, because back then value did really well above the historical average, but it just couldn't keep up with this incredible growth that these the large growth companies had. And if you fast forward between then and the great financial crisis, what you see is that the value continued to chug along, but these large growth just completely ran out of steam, ran into the ground. And when you look over the entire period of 1990 to 06, what you get is pretty much spot on the long term historical average. So to me, again, the issue here is more that the value is doing exactly what it's supposed to do. This is the long-term average for growth, and this is way significantly above. So this is
Yeah,
the anomaly. So I'd be actually a lot more cautious around growth than I would be around a value. And if you don't mind, I'll give you one last take on this that just kind of I just happened to see not too long ago. If you look at these as an investor and you say, okay, if I were to buy these assets from these companies to see how expensive they are, if you look at large growth and you say, how much would it cost me to buy $1 billion in assets after liabilities are paid? That's called the book value. And if you look at the price to book ratio, that tells you exactly how much would it cost you to buy $1 billion in assets. That in large growth would cost you roughly about $10 billion. So you'd spend $10 billion and you got 1 billion in assets from these large growth companies. If you look at small and value and you ask the same question, what would it take to buy 1 billion in assets? That's roughly about 900 million. So as an investor, what sounds more appealing? Almost pennies on the dollar, or paying tenfold for the assets? And that's why I don't. I'm not suggesting go pile all the money in small value. Not at all. I just think that it still makes absolute sense to invest the way that we've done it up until this point.
sure. The other thing I think about when I see those charts, and those on this call that know me or we've talked, it reminds me of, I've done a lot of data. You know, you can play in data, and you can really get in there and look at. Like I was thinking about your 9 decades, and I was also thinking, what about on a rolling basis? So suddenly you
Yeah.
have a lot more 10-year periods and all that. When you do all that, it really comes down to, if you have perfect clairvoyance, then you would have 1 decade done this, and you would have done this the second decade, and of course you would have done fantastic. Without perfect clairvoyance, then you do these kinds of things that give you higher probability to either reduce volatility or have better returns or those kinds of things. If you're a betting person, you're like, okay, my odds are better if I do this and tilt it a little
Right.
bit and do all that. And invariably, when you look at the few people on the planet that get it right, what you find is they got it right once.
Yeah.
My joke about economists, right? They predict, 9 of the last 3 recessions, and all right, you say all these things enough, and eventually you're right. So anyhow, I digress. There are
No, but it's a great
several.
point.
Yeah,
Great
no,
point.
thank you. Listen, there's several questions. We only have a few more minutes. There's several questions, and I know this comes up all the time. I don't know that in my 59 illustrious years, I remember such a contentious political environment, at least not as an adult. So, of course, elections, right? So, you know, what's the thinking, or you know, yeah. Well, what's your thoughts in
Yeah.
terms of impact on markets, maybe
Yeah.
impact longer term, that kind of thing?
So we looked at this issue because it is an important issue. It was probably the number one question at the beginning of the year. I'm sure it's coming back to be top. And I'll give you the punchline and then the reason we looked at it. So the punchline is when we looked at all the data from an unemotional perspective, because I do think that politics these days is highly emotional. I know couples in counseling because of politics. And I think that what we need to do is disentangle emotions from investment decisions. And when you do that, what you see is the fact that we have an election year, or whether we'll have a president, a good new president or not, that should not form the basis of an investment decision. You should not make a move in the portfolio because politics doesn't impact the market as much as one might think. And I'll give you the three sort of areas that I've looked at very quickly. The first area is, if it's an election year, does it really matter from an investor perspective? Secondly, does it matter if we have a Republican or a Democrat in the White House? And thirdly is, how much do the policies of the government when it comes to taxes, when it comes to all kinds of things, tariffs, how much do they matter when it comes to market returns for investors? And I'll give you quickly the punchline because I think it's fascinating. If you look at the U.S. stock market over the long run, the average growth per year has been about 9 to 10% per year over the past 93 years since we have good data. Well, in these 93 years, we have had 23 different elections. So 23 different election years. And when you look at the average of these 23, the question is how much lower or how much higher would it be relative to the long-term trend? And what you see is that the average is pretty much spot on at 9.5%. So not any different. Very, very similar. When you look at the average the average return in an election year, it's not any different. But average means that sometimes you have good years and sometimes you have bad years. So when you actually examine the 23 different election years, what you find is that 19 out of the 23, the market went up, and only 4, it went down. So the preponderance is the market goes up in an election year. But I was interested, what happened in the years when the market dropped? And the first time that happened was in 1932. And that we had an election, but we're also in the Great Depression. So that probably mattered. And then 8 years later, we had a negative year, but there was also the year when Germany invaded Europe, and you kind of knew that you're going into a world war. And it took 60 years until the next time we saw it, and there was a negative year and an election. But there was also when Pets.com and all the other high-flying tech stocks went bust, and then obviously the last time was in '08. And the point that I'm making is that when you look at election years and market returns, the only 4 years that we saw negative returns, as an observation, it seems there are a lot bigger things going on in the world than the election itself. And even if we go back 20, 30 years from today and we look back at 2020, and knock on wood, if it turns out to be a negative year in the market, we'll remember this most likely because of the coronavirus rather than having an election year. So the election year by itself, it doesn't scream like we should make a move. Majority of time it goes up. When there's something big in the world, it's possible that it would go down. Now, what about if we have a Republican or a Democrat? And in this, I went back to the year I was born, 1969. And when I was born in 69, President Nixon was in office. And on average, during the 5 years that President Nixon was in office, the market dropped by about 3%. And then Gerald Ford came in, and the average was 20% for the 3 years that he was in office or so. And then if you fast forward across different presidents and you look, what was the average market return during their tenure? The first thing that jumps at me, it's nothing obvious. I can't tell you that having a Republican or a Democrat makes a big difference. I mean, first of all, I don't think that any president should receive neither credit nor blame for what happened during their tenure. You take President George W. Bush, he cut investment taxes, whether long-term gains or dividends, very business friendly, and yet the market dropped more than 4% on average per year during the 8 years that he was in office. Now, he walked in just as the dot-com was going bust. 9/11 happened 9 months into the term, and he walked off at the very bottom of the great financial crisis. And on the other hand, you had President Clinton, who presided over this phenomenal tech boom, and talk about market timing, just walked off just before it went bust. But to me, the point is that how much should you give credit to President Clinton and blame to President Bush? I don't think that's right at all. And even the way that the presidents are perceived, I have the perception that that President Obama was more interested in social programs and obviously Obamacare, and yet during his tenure, the market went way above the historical average. So it's not really something that when you look at it, you can say, aha, because we have this president or we have an administration, that's going to make a difference. But the last point I think is hugely important, which is that when you look at the stock market, what is driven by is profits, and profits have to do with the company, the products, the competition, the strategy, how they execute the strategy. That's much more relevant. The market forces are more relevant than the policies. If you look at the last few years, we have had a policy that really was supposed to help an industry like the steel industry, and the tariffs were really supposed to help. And in fact, if you look at what happened and how market forces play out relative to political forces, and you take the company that bears the name US Steel, what happened after the tariffs were imposed? Well, what you saw is there was a run up in price with the market expecting these tariffs. But ever since then, with the tariffs in place, the company has been on a significant downward trend in terms of stock prices. So as an investor, you tell me. I mean, you would have cheered up that, hey, look, we have a company now that is benefiting from tariffs, and yet it didn't mean anything to an investor. And even when now people are saying, well, what if we have a new administration, maybe some of the tax cuts. Well, there's an argument to be made that maybe in the short run, a tax adjustment might have a positive or negative impact on companies. But there are a lot of other things that he can put into play. Trade, we talked about this. It hasn't been all sunshine for trade when it comes to these companies. So it's possible that there's so many dynamics that it's really not possible to say that one administration um, is gonna make it work or not. And the last thing, this is my one of the things that I want to leave people for. Have faith in free markets. That in these companies, they will find a way to make money in whatever state of the world will be. Whoever will be president, they'll find a way to make money. And for me, the premier example is look at the darkest days of our parents' generation, World War II. During World War II, if the companies couldn't make cars, they basically sold tanks. And what you saw the result is that even as the market was pretty down, as we entered the war, because the last 4 out of the 5 years before we entered the war in December 1941, you would have had such a pessimistic view that, boy, it doesn't make sense to invest. 4 of the last 5 years, I've lost my shirt in the market. Now it's December 41. We're in the war. Millions of people are dying. Everything is being destroyed. Cities are being destroyed. Stock market's the last place that I want to be. The incredible thing is that because these companies in free markets are able to adjust during the full years of war, a dollar invested at the beginning of the war would have pretty much doubled by the end. Every single year was positive. With an average, there was a staggering 22%. So again, I'm not placing my faith in any one government, in anything, but I'm placing my faith into this idea of free markets. That in free markets, companies will find a way to capture opportunities in whatever area they might need to look at.
That's awesome. I see we have like 3 or 4 more minutes, and there's one more thing I want to tee up
Mhm.
because I'd love to hear your thought. We have a number of questions in general about international investments, and I know you're a global company. I have good friends at Dimensional, and they're all over the place and all over the world. Can you just take a couple minutes and talk about your thinking and outlook and sort of how you
Yeah.
think about international investing?
Yeah. So the way we think about international investing, it has to do a lot more with the company than the country. So when you look at a world map, not drawn based on landmass, but based on the value of companies that you can buy and sell in any one country, what you see is in the U.S. there are about 3,000 companies that you can buy and sell in the U.S. And they amount for about 54% of the value of all companies around the world. In the same way that we have a Ford and a GM right here in the Midwest, well, there's a BMW in Germany, and there's a Toyota and Honda in Japan. So the idea is that we want to look around the world as well, because they're perfectly feasible, good companies. And in fact, there are 9,000 other opportunities around the world that we can explore. And there are times when the U.S. is doing really well, but there are other times when these companies are not doing, the other countries are doing well. So if you look on the short-term basis and you look year by year and you kind of say, okay, every single column here is a year, the best performing country is on top, the worst performing is on the bottom, and each country obviously has a color code that's throughout. What you see is that it's very very random in terms of what country comes up on top. But what is fascinating is that as much as we think that the U.S. is a phenomenal performing stock market, it's not. Over the past 40 years, the U.S. has never been the best performing stock market. In fact, for years and years and years, the U.S. was towards the bottom, and it was a lot of other countries that had to prop it up and hold it up because it was performing so low. And in fact, if you really want to see the best performing markets, then you have to go more towards emerging markets because they've had a phenomenal returns. If you look, last year, Russia. it was almost twice as much as the U.S. return. That's where you have like a Brazil, 128%. You have Colombia. So if you really are looking for high flying countries, they tend to be much more on the emerging market side. But that's short term. And what we're saying is that if you actually go and you buy among all of these, then you basically avoid extreme returns. The U.S. has not been on top for any one year among all these countries. But yet, when you look at the U.S. and not on the short term, year by year, but you look over a decade, once again, in over the past 10 years, the U.S. has been close to the top. Not the best performing country. New Zealand took that honor. But the U.S. was second best performer. So people are saying, well, the U.S. it seems like it's great. Now, all you have to do is just look a decade before, and what you see is that the U.S. was towards the bottom. So, from year to year, from decade to decade, you kind of see these moves that the US could be on top or the bottom. And all you have to do is actually look now decade by decade, by look decade by decade. And if you do that, what you see is that when you combine all the other countries into this MSCI, so all the companies, all the countries outside of the US, you saw that the last 10 years the US did do better. But if you take it decade by decade, it absolutely made sense. In the 1970s and 80s, these international companies significantly outperformed the US. In the 1990s, we had the technology boom where the US outperformed, but we know what happened afterwards. It was the hangover of the lost decade. So, absolutely, I find it's a really important argument to go beyond the S&P and invest globally. And it's perfectly fine for the US to do better at some points because you want to see that seesaw. You want the US is doing well, great. We have that. It's the largest piece of the portfolio, but we also want to buy a little insurance by putting some money into international companies. And to what degree you do that, that's something that Private Ocean works with you to figure out what's the right balance, the right mix between US and non-US companies. But I'm 100% a big believer in buying because I don't understand, like, conceptually, if it makes sense to own Ford and GM, why not explore others? If we have Apple, why not Samsung? It makes a lot of sense. We have Kraft in our pantry, why not Nestle? I have both those products. uh,
That's
so
exactly right.
anyway, so it's
Well,
I'm a big believer in diversification. When you look at the data, it absolutely makes sense. Um, and I don't know why, just because something did well for the past few years, let's just move everything. No, the world hasn't changed that much. And as you
sure.
saw, it's most handful of companies that have done well, not necessarily every company in the US.
Understood. Apollo, I want to wrap up. Our time is up. I want to thank you personally and professionally for this. I'm sure our clients liked it. If I know there were some questions I didn't get to, please feel free to reach out. Give us your questions. We'll make sure we get Apollo. We'll make sure we get you answers. There were some really technical good ones, and I thought, this is terms I haven't seen since like my graduate school days. So I'm looking forward to that. But thank you again so much for all of you for attending, and have a great day and be safe. And we'll do this again soon. Take care.
Thanks. Bye bye.